Hi, this is Randy Finney with Right Side of the Chart, and today is Wednesday, February 8th, 2017. In this video, I wanted to take a look at just a few of the sectors that stand out to me right now, those that I'm following closely. Starting with gold and GDX, there's always seems to be a lot of interest in the mining stocks and precious metals. So take a quick look here. I've updated quite a few charts on the front page and a lot more in the trading room, which is most often the case. The majority of my analysis and updates are posted in there, but every now and then I'll do a front page post or video, and let's go ahead and dig into the charts here. Not a lot has happened since the last update. This is a daily chart of gold. This is that bullish falling wedge pointed out back in December. Broke out. Gold had a heck of a run, hit this 115.70 level, which was a downside target back on these two short trades back in 2016, I'm sorry. And so far, what appears to be here is we had an uptrend line. We hit resistance at that 115.70, pulled back from there, came back up, appear to be almost back testing this from below. You can see that we start to have resistance come in here. I have a resistance zone. It was a former support zone way back here. But if you look at these previous reactions down here, see all these candlesticks as I zoom in? That will be support. So this is really a support zone, if you will. So if gold continues to push much higher, it faces significant resistance up here in this zone here of these levels, and more so at the bottom of that level. I think that we have quite a few reactions back here come into play. We have gaps back here, reactions. So either way, pretty significant area, and gold will be, and it already is pretty stretched. As I always say, overbought can become more overbought as it did back here and here and here. So, in fact, gold's overbought right now in the RSI. Isn't by itself a reason to sell, but as I mentioned, taking profits recently on my positions, and I plan to buy back in on a pullback. Now, let's zoom down to the 60-minute charts. That's where I've been living, if you will, recently. I always keep an eye on all time frames, but the 60-minute charts really help me hone down my entries and exits. So this is a chart I've been posting quite a bit lately, updates on this one, and we still have those negative divergences that I mentioned. I'm using a PPO here in lieu of a MACD. MACD will tell you pretty much it looked the same story. And, just as you had positive or bullish divergences down here at the low before that breakout, which led to an uptrend or a trend reversal, we have negative divergences right now on all the price and momentum indicators and oscillators. Price is wedging up within this bearish rising wedge pattern. Here's a trend line to watch. This is probably the most important level to watch right now, as well as at 117.32, because that was a decent resistance level here. Let's see if I go back to a 2-hour chart and zoom back a little more. Now, we don't have any reactions there, but we had quite a few reactions there. So that was a resistance level. Gold did punch through it. So on face value, that's bullish, although this has been not a very impulsive breakout. So we have one of two scenarios here. We either have what I often refer to as a wedge overthrow, which occurs right towards the top of a wedge, right as it starts to approach apex around the point where a wedge will break out. And these overthrows are very bearish. They're not uncommon to see, especially during a fairly strong momentum run. So watch for a move back down within the wedge. And from my experience, when you have these overthrows, they're relatively fleeting. They don't last that long. And then they're followed by a pretty sharp move down and out of the wedge with a breakdown of the wedge. So any or all of these levels down here, the green lines, are potential price targets. You may gain reactions. And I think, at this point, my furthest downside target for a pullback on gold, an area where I'd be very interested in accumulating long exposure. Again, if the charts verify or confirm when we get there. It's hard to say right now what the 60-minute or 15-minute or even daily charts will look like. I confirm all my trades, multiple time frames, not just one. But this would be a nice, I think, buy zone down here around 111.50. And who knows? Maybe the pullback's over. Maybe that was it. But I still favor, especially with the divergences in place in this rising wedge, that that move back down. Now, even if this isn't an overshoot, we can take this trend line here, move it higher, and essentially we still have negative divergence. So all we have to do is a simple redraw of the wedge. This may not have been. In fact, that this trend line here only had a couple reactions. So, as long as we have a divergent high, that puts me on alert for a potential trend reversal. And as such, I don't have an interest right now, and I'd rather wait for a pullback to reestablish those long positions. And just yesterday, I put on a short position on the gold mining stock. So we'll get to those right now. GDX. This is a 60-minute chart. Same one I've been talking about. We have, we can see here reactions. So this is a resistance zone, these two lines, when you have two resistance levels in close proximity. And you can see we perfectly kissed the bottom of that resistance zone today. So GDX is up a little bit, but for the most part, it seems to be stalling out here, and the divergence is very clear, very pronounced on GDX down here. You can see on the price and momentum indicators and oscillators histogram that I have down here. So this is what I'm looking at on GDX. It seems to be a rising wedge, or at least working its way up within this channel. This was an uptrend line here. We broke below it, bounced under it briefly, got back up within there. So I'm looking at both of these as potential trend lines that may come into play. You could actually extend this one down a little bit down here to that gap. But either way, let's watch for a break of those two. There's some horizontal support I could add at this point. Definitely a level here to watch if you guys are looking to maybe just game a quick pullback trade on something like Dust or a Nugget short, or a straight up GDX short. That would be, other than these trend lines here, that would be your first support level right there. We'll call it 24.25. Always try to round up if you're going to cover. And there's even a little gap and a little support above there around 24.60 or so. But, it depends on what gold does. And as I said, gold has the potential to go back down quite a bit based on the charts. And so does GDX. So if this gets really ugly, this wedge pattern breaks, it's pretty sharp divergence. It spans all the way from the beginning of the year. So we have almost 2-month divergence on negative divergence on GDX. So based on that, my guesstimation is that this correction could take us all the way back down here to that looks to be about the 20. This support zone here runs around 2150 to 2175, 2180, give or take. And again, this is where I'd be very interested in accumulating some, reacquiring those the longer term swing positions in the miners. Now there's support. Any of or all of these lines could also, end a pullback if we get one here soon. So that's my take on the miners. I'm still looking for a pullback. I zoomed out now to a 2-hour period chart just to go back a little bit more in time, and I just wanted to. The focus here is to show you all the reactions really that you see here, including this big gap right here. So this helps define that resistance zone. You can see all the reactions in the past. Now, if gold can power right on through it like it's not even there, I don't see a whole lot of resistance up until up here around 21, looks to be about 2175 or so. You can see all of these levels back here, quite a few, gap right there, reaction high. So this is my the next target, again based on the charts and the scope of these divergences. You can see them here as well on this 2-hour period chart. I'm betting on a pullback first, and then if depending on how the charts look, a resumption of the uptrend and a move up to that target. All right, so that's gold and GDX. Not much more really, not anything I haven't covered recently. Not many more updates. Oh yeah, and I'd be remiss. I talk about the dollar. Always try to incorporate the dollar into my analysis. And this is the UUP 60-minute bullish falling wedge I pointed out. We had an uptrend line here. The dollar was in an uptrend, broke down, back tested, and has moved lower since. In this bullish falling wedge pattern defined by these two downtrend lines, you can see nice strong bullish divergence in place down below. We had a breakout, and it looks like the dollar just wants to come back in and back test that, which is fairly common to see a back test of a wedge after a breakout. So if the dollar continues to play out as expected, I think we go up to any or all of these targets and then reverse. And remember, a rising dollar is bearish for gold at almost all points in time. There are some temporary disconnects, but that tends to be the inverse correlation there between the dollar and gold. Okay, moving on to another sector that has been on my radar. I haven't posted a lot of updates on at least on the front page. I did, however, let's take a look at the energy sector, because the energy sector is one of the most important sectors in the S&P 500. Oil has been on everybody's radar in the last couple of years after the with the vicious bear market that we've had. So I wanted to point out, this was posted in the trading room about a month ago. Member Lee One had asked my take on XEGTO. So that's let's see, I'll show you the chart in a second. It's an energy ETF that trades on the Toronto Stock Exchange. And my response was here is that my take, for what it's worth, is the energy sector is poised to take a breather after a heck of a run in 2016. And I showed a couple charts here. The first one is XGTO. Again, this was a month ago. I mentioned this bearish rising wedge with my expectation of a breakdown. There's some potential price targets. Now let's take a look at that. Fast forward today, about a month later. And you can see, just like clockwork, breakdown, back test. These are all the levels I had on the wedge. These are why, list different support levels, different targets. You typically get reactions. After breakdown, we back tested the wedge. We also back tested this horizontal support level here around 1350, and then fell, hit the next target support around 1282. That's a reaction, a little bounce off that level after, these are intraday. You see these wicks, but look how perfect the body closed on it, and then we bounced. Then once that level support, once broken, becomes resistance. So as I say, you often expect on the initial tag of these support levels or targets from above, my expectation is often for a reaction. That's why they're listed. So we went through, and now we've smashed through that 1247 support as well. Pretty bearish stuff. So hopefully that either saved Lee some money on the long side if he was either long or thinking about going long, or maybe profited from a short. I didn't trade that one personally. Typically trade this ETFs trade on the US exchange. But let's look at the other chart in there. So that was XGTO back then, and I also shared my take on XLE. Oh, sorry, I might have had that last one cut off. If I did, here's I just moved the chart up. Remember, when you guys click and zoom charts on right side of the chart, when you click it to expand any chart, press left click on your mouse, hold, you can pan, move the chart around. If you have a scroll wheel, you can zoom in, as I'm doing here. You can zoom out. So there's a lot of flexibility. If you don't have a scroll wheel, see these little dots right here in the corner? You can just click and hold that, and you can drag to zoom. So it's easy to zoom in and really get a close look at these levels. So again, this was from a month ago. There it is, time-stamped on January 11th, and this was my expectation. A breakdown. We overshot this channel here, and so I drew two scenarios. We either pull back here and bounce off there. So I was looking for at least a pullback to that level, and if this level goes, then a breakdown to the bottom of the channel, then a reversal. All right, let's fast forward to today. Take a look at the charts. XLE. I haven't modified any of these lines, and that's exactly what happened. So we broke down. We actually bounced on the first tag of that level. We had a little reaction, but it was very muted, and we've since come back down, and now we broke below it today intraday. So far, a little stick save, no pun intended, meaning candlestick has dropped way down below intraday. That shadow or tail just shows the intraday action, but right now, green, so we're just above that level. In other words, XLE is fighting for its life. It's trying to hold on to this support level. At this point, you can see that the PPO is now crossed down into bearish territory and is still pointing lower. Bearish territory meaning it's below the zero line, that dotted line there. And again, it's still pointed lower. So I don't see anything. We haven't become oversold yet. Although you are at support, and support has held today after a brief flush out, so it's not really objective to short it here, but keep an eye on that. If we take out that level, especially if we take out today's lows, the bottom of that candlestick, we're most likely going to go down and hit that second target that I had there before a reversal. And keep in mind, if things get really ugly, that was my scenario at the time, I'll watch to see what happens here, how the energy stocks and the sector looks. But next stop, if that gives way, although there's maybe some minor support, this is the next big support level, all the way down to the $64 level. And that would have very bearish implications on the broad market, because that would be a drop of another 10.5% from the roughly 10% drop that we've already had. So something to keep in mind. Okay, those are levels to watch on XLE. Okay, XBI. This is another one that I've put more updates in the trading room than the front page lately. People have asked my opinion. I've stayed clear recently from the Biotechs because the simple fact I've stated they're in this is a symmetrical triangle pattern. The most important lines on this chart are these yellow lines, a very large symmetrical triangle pattern. We're looking at a daily time frame. And somebody inquired about it recently. They inquired about a breakout, and I commented on that in the trading room. I've made a few comments and posts on this. We had a breakout, but it was unimpressive. It was not impulsive. See this breakout the other day? And so I was watching and have been leaning towards a failure. So far, a very weak, non-impulsive breakout. But yet it is a breakout, so this is by no means go ahead and short right now. But what I'm watching for is to see if the Biotechs fall back down within the symmetrical triangle pattern. Okay, so we're at a pretty important technical juncture for the Biotechs. A breakout, maybe this is a breakout and successful back test, meaning that the Biotechs will then punch up to this next resistance level here at $69 if that level holds. Maybe we want to back test for a little bit longer before moving up. However, should we fail, if the Biotechs fail here, then my expectation would be a move down. And not a straight move down. There's some support along the way, but a move down to probably the support level here. It's 59.55. Let's see the support. And ultimately, if that goes, then you have the next support is the bottom of the triangle pattern. Let me zoom back out for you. So this is the bigger picture. And as I mentioned, one reason I stay away from the Biotechs, when a stock or a security or index or a sector is in a symmetrical triangle pattern, the price and momentum indicators flatten out, so you have very little value. It's hard to ascertain the direction or which way these things are going to break. You just have to sit patiently and wait for the breakout. However, again, a failed breakout, I say fewer things in trading are more bearish than a failed long side or bullish breakout, as fewer things are more bullish than a failed downside breakout. So should this breakout fail, that would be bearish. You tend to have a lot of traders watching that downtrend line in the triangle, and they probably went long on there. So if the breakout fails, you have to see a lot of repositioning. Stops will be hit. People realize the breakout failed, and that could then bring us down. So there may be a trading op here soon, and ultimately look for an impulsive, definitive break in either direction on the Biotechs, and that will likely determine the next major trend. I've shared my thoughts for a while now that so far from the bigger picture, this is going back a weekly chart. And, you can see the primary bull market uptrend line, a breakdown, and what appears to be nothing more than, at least at this point, technically it is nothing more than a bear market rally, because this was certainly a bear market. That drop was, I think, almost 50% or so. Big drop in the Biotechs, and I'm using log scaling, so it may not appear to be, but it's dropped from 90 down to 45. That's a 55% drop, 50% drop. And so as you can see, we've only retraced. See these little dotted lines here? Go to the left. We've only retraced 50% of that drop so far, which is your run-of-the-mill counter trend bounce. So again, this is something I've maintained for months. It's just weekly charts. You just have to give it time and have patience. But we may be looking at the next leg down in a new bear market in the Biotechs, or maybe we take that level out. If we break that symmetrical triangle and the bear market is over, then ultimately we might work our way up to the previous highs and beyond. So again, we just have to wait patiently, but we may know soon, especially if we see a failure here on that breakout there and an impulsive move back down within the triangle pattern. Okay, the last sector I'll touch on is XRT. I haven't really worked up these charts very much. I've been following the sector. You know, they say retail spending, consumer spending accounts for what is it, something like 70% of the GDP in the U.S. So it's a very important pillar of, our economy. And this chart, doesn't really mesh with what's going on in the stock market. It seems that tech stocks, your Facebooks, and so a few others are really driving things, but you can see that this is a weekly chart I just zoomed out to. We had a divergent high back here in the retail stocks, and that's where they topped and have yet to even come close to those highs. So we had already technically a bear market. We dropped 26% already off the highs in just less than 10 months. We're stuck between support and resistance. So a lot, that seems to be the theme recently in broad markets and a lot of things. It's just these sideways trading zones and this indecision. There was a breakout to new highs that didn't stick, fell back in that trading range. And so with the retail sector, these are the key levels from a longer term point of view. Wrong tool again. Either a break down below the support zone or a solid break above the resistance zone. So we just have to wait and see. But again, when we go back to that daily chart that I started with, the most important thing to note right now is the XRT is at support, trendline support. You can see several reactions off the lows, and we also had a divergent high. You can see the negative divergence right here at that high. So there it is. And not looking good if this trend line breaks. But until then, it's trading 101. You don't want to short here because you're at support, especially after a very sharp drop. That's the other thing. So you're oversold, at least in the near term, intermediate term time frames, and at support. So maybe a bounce up, maybe not. But ultimately look for a solid impulsive break below this level, especially a weekly close. Be leery of intraday breaks. See this little whipsaw signal here. This is why I like to, trade and watch for a candlestick close commensurate with the time frame that I'm trading. In other words, if you're trading a daily time frame, you want to see a daily candlestick close below, because you had this intraday break and then a very sharp reversal that took all the way up here. That was a very bullish candlestick, bullish engulfing stick, and that was a little fake out intraday move. If you're trading a weekly chart, that's why I like to often wait for a weekly closing stick. Same thing with the 60 minutes. So there it is. Those are levels to watch. You can see overhead resistance levels if we do bounce, but most importantly, watch this trend line for a definitive break and close below on XRT. All right, this has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.